While retail investors are panicking out of the market, financial giants are quietly building crypto's future. The modern investor highlights a massive disconnect. Citibank is actively working to make Bitcoin bankable for its institutional clients. This isn't just a small project, it's a fundamental shift in traditional finance. We're seeing this institutional strength play out in real time. CryptosRus points out that despite escalating global tensions, Bitcoin just staged an impressive recovery back to $69,200. He sees seller exhaustion meeting a wall of institutional demand. But what if you could accumulate without being an institution? CryptoKC reveals a strategy using Uphold to earn up to 4% back in crypto on your salary and spending, essentially turning your bank into a Bitcoin generator. So are the big players creating a system that leaves you behind? Or are new opportunities emerging? In the latest video from The Modern Investor, the host points out a familiar pattern. While everyday investors are getting scared and leaving the markets, the big financial players are quietly building the future. He's seeing a huge disconnect where retail is terrified, missing what could be a massive opportunity for creating wealth, while institutions are laying down serious infrastructure for crypto. The big news is from Citibank, which announced plans to introduce infrastructure to make Bitcoin bankable and integrate it into traditional finance. This isn't just a small move. It's part of a larger trend where giants like BlackRock and Fidelity are accumulating enormous amounts of Bitcoin, far beyond what's seen in ETFs. The speaker also touches on how the 24/7 nature of crypto is pushing traditional markets, like the New York Stock Exchange, to consider round-the-clock operations. Shifting gears, he discusses Ripple's ambitious roadmap for institutional DeFi on the XRP ledger, aiming to build a complete financial operating system that could rival traditional banking functions. The video paints a clear picture of a market in transition, where the smart money is strategically positioning itself for a future where crypto is deeply embedded in the global financial system, leaving many current investors behind. The video's central theme, the growing gap between institutional strategy and retail sentiment, is a recurring pattern in crypto, and current data strongly supports this view. While the speaker notes retail investors are fleeing, recent on-chain analysis confirms this, showing a multi-billion-dollar contraction in retail inflows to exchanges, just as institutional ETF holdings are surging. This isn't just a feeling, it's a measurable shift where institutions treat volatility as an accumulation opportunity, while retail traders react to short-term price swings. The Citibank news is a perfect example of this long-term institutional play. Reports from late 2025 and early 2026 confirm Citi's plans to launch institutional-grade custody and integrate Bitcoin into its core services, aiming to bridge digital and traditional assets on a single platform. Similarly, Ripple's push for an institutional DeFi stack is gaining traction, with recent updates focusing on features like lending protocols and tokenization to attract regulated financial firms. This all points to a market that is maturing and bifurcating. While retail chases speculative narratives, institutional capital is methodically building the infrastructure for the next financial era, focusing on compliance, tokenization, and regulated access. In the latest video from CryptosRus channel, the host dives into the market's surprising strength. Despite a rough start to the day and escalating military actions in the Middle East, Bitcoin staged an impressive comeback. It rallied from the $65,000, $66,000 range back up to $69,200 at the time of filming. This resilience is a big deal because it suggests we might have finally hit the bottom, pushing back against all the fear and uncertainty. The speaker points out that while global tensions are rising, with Iran launching attacks and key figures like Marco Rubio warning of more to come, Bitcoin is holding its ground. This could be because people in the affected regions are using it as a safe way to protect their money. The host believes that the sellers are tired out and that big institutions are still buying, pointing to strong ETF inflows from the previous week. He compares this moment to past crypto winters, where things looked bleak before a major recovery. Looking ahead, he sees a path for a U-shaped recovery, first to $75,000, then to a CME gap around $78,000, and potentially back to the $87,000 to $93,000 range sooner than people think. The video's central theme of Bitcoin's resilience in the face of geopolitical turmoil is a fascinating and recurring narrative. While the speaker suggests Bitcoin is acting as a safe haven, current market analysis presents a more complex picture. Reports from early March 2026 show Bitcoin's price action is still highly correlated with risk assets like equities, often selling off initially during major geopolitical shocks. However, Its ability to rebound quickly, as noted in the video and by other analysts, suggests a unique dynamic is at play. This isn't necessarily a classic safe haven response like gold, but rather points to a maturing asset class with a dedicated base of buyers. The speaker's point about institutional interest is well supported by recent data. Spot Bitcoin ETFs have seen a significant turnaround, with hundreds of millions in net inflows recently, ending a multi-week streak of outflows. This data from sources like SOSO Value indicates that while retail sentiment, measured by the Fear and Greed Index, remains in extreme fear, institutions are viewing price dips as buying opportunities. This divergence between retail fear and institutional accumulation is a strong undercurrent that supports the video's bullish long-term outlook, even if the immediate price action remains choppy due to macroeconomic pressures and the ongoing conflict's impact on energy prices. In the latest video from Crypto Casey, she reveals a straightforward method for accumulating Bitcoin at no cost by optimizing your daily financial habits with an Uphold account. The strategy revolves around replacing your traditional bank account with Uphold to benefit from higher yields and cashback rewards. By setting up a direct deposit, you can get your paycheck up to 2 days earlier and earn 4% back in XRP. Using the Uphold debit card for everyday purchases like gas and groceries can get you another 2 to 4% back, also in XRP. Plus, any US dollars you hold in the account earn a 3.75% APY, which is significantly higher than the national average savings rate and is FDIC insured up to $2.5 million. Casey emphasizes Uphold's transparency, noting they maintain a one-to-one reserve for all customer funds and publish this data in real time. The core of the plan is a simple 3-step process. Earn rewards on your income and spending, and then easily convert those XRP rewards directly into Bitcoin. This transforms routine financial activities into a machine for stacking SATs. The video also touches on using an AI trading bot, GoBabyTrade, to generate profits from idle capital and securing your accumulated Bitcoin in a Tangem hardware wallet. The strategy presented offers a compelling alternative to traditional banking by turning everyday financial activities into a passive crypto accumulation engine. The high cashback rates on both deposits and spending, paid in XRP, are particularly attractive in a market where such rewards are becoming more competitive. While the video focuses on converting rewards to Bitcoin, the choice of XRP as the reward token ties users to its market performance, which can be both a risk and an opportunity. The emphasis on Uphold's full reserves is a critical selling point in today's climate, appealing to users wary after the collapse of other platforms that lacked such transparency. However, the broader regulatory environment for crypto yield products in the U.S. remains complex. Recent legislative efforts like the Genius Act aim to provide clarity but also impose restrictions, particularly on interest-bearing stablecoins, which could influence how platforms structure their offerings in the future. The market sentiment is currently cautious, with geopolitical tensions impacting risk assets, including cryptocurrencies. This makes platforms that bridge traditional finance with crypto, like Uphold, an interesting proposition. But users should remain aware of the inherent volatility and regulatory shifts in the digital asset space.
So after breaking down these different perspectives, a powerful pattern emerges. Across the board, the analysis agrees. Institutional money is here, and it's not just buying. From ETF inflows supporting the price to big banks like Citibank building long-term infrastructure, the smart money sees this volatility as a major opportunity. The real divergence is in focus. Should we watch the short-term price action or adopt practical strategies to accumulate for the long run? The biggest unanswered question is when retail sentiment will finally catch up. The key takeaway is this: look past the daily fear. The most important trend is the deep integration of crypto into mainstream finance, a move being led by the world's largest institutions.